Good afternoon and welcome to BizTech's Asian Midday Market Watch. Our guest today is David Koh, founder of the Smart Investor, coming out of Singapore. David, great to have you on the show this Friday.
Yeah, Selamat Tengah Hari, Brian.
Now, before we get your insights, let's first take a look at cryptocurrencies. We've got Bitcoin, which is at 38,486.5. It's down 2.67%. Ethereum is at 2,538.18. It's down 4.53%. Now, looking across the regional stock markets, we'll start close to home with the SGX. The Straits Times Index is at 3,240.4. It's down marginally 0.01%. Now, if we look across the region, however, the position is not as good at all. So just give me a second. I think I've got the wrong chart that I'm showing you. But let's go to regional stock markets. And we have the KLCI, which is at 1,561.84. It's down 1.18%. Shanghai is at 3,222.12. It's down 2.24%. The ASX All Ordinaries is at 7,338.1. It's down 0.98%. The Nikkei is at 25,070.5. It's down 2.41%. The Hang Seng is at 20,155. It's down 3.52%. And rounding up the numbers, we've got the Kospi, which is at 2,652.92. It's down 1.02%. David, it's a sea of red. Tell us why.
Well, I think it's primarily because of what the ECB did or said yesterday. Christine Lagarde was, for want of a better word, quite hawkish about inflation, and she was commenting on the war between Ukraine and Russia and the elevated energy prices and how that could possibly feed into inflation expectations. And the one thing she wants to try and avoid is higher inflation expectations, because as you and I know, Brian, if we expect inflation to be higher, then chances are that we will ask our bosses for a higher pay rise, and that is very sticky. The moment you do that, then of course you can't reverse that. I've never known a boss turn around to his or her employees and say, "Oh, we're cutting your wages because inflation is coming down." Once you've actually sort of done that, then it will stay forever. So
exactly.
People are very concerned about higher inflation and what the central banks in Europe and the US will do.
Now, David, equity markets have taken a bloodbath across the world because of uncertainties in global markets. Commodity markets, on the other hand, have spiked up. But I want to zoom in a little bit on Chinese stock market, especially Chinese tech stocks, and they seem to have taken a beating.
I'm just going to show you a
chart here, David, which will emphasize my point. And it's a sea of red again.
I mean, just look at that. I mean, JD.com, just at the lower end of your table, down 16%. Pinduoduo down 18%. Alibaba down 8%. I mean, these are frightening numbers. And it's very difficult to try and sort of discern what is actually causing that. We know that tech stocks tend to get hammered when interest rates go up, because ultimately, when you buy these tech stocks, what you are trying to do is to discount earnings from very far into the future to today. And when interest rates go up, then the chances are that those earnings are going to be less exciting at today's level. So interest rates are definitely a problem. Then we've also got overlaid on top of that the crackdown on tech firms by the Chinese regulators. I mean, I just saw on the newswire before we came on air today that Didi is shelving or postponing or maybe canceling its listing in Hong Kong. I mean, Didi floated on the American stock market, and at the end of last year, it said it was going to delist in America and list in Hong Kong instead. Now, if it delists from America and it can't list in Hong Kong, where is it going to go?
Exactly.
The regulators are very concerned about Didi. And when you have a look at this crackdown on tech firms by the Chinese regulators, it doesn't really help the share price. Then you've actually got one third issue, and I'm going to have to refer to this. It's called the Holding Foreign Companies Accountable Act in America. And what this actually says is that Chinese companies that want to list in the US have to make their audited accounts available to US regulators. If they cannot do that, then they will have to delist from the US. And America has already highlighted a handful of companies, and these include Yum China and also Hutchinson Medical, HUTCHMED. So these two companies have already been identified by the regulators that they will need to make their accounts available to the auditors in America. You would have thought that isn't really a problem, Brian, but according to Chinese law, the Chinese auditors cannot make those accounts available to Chinese regulators. So if that were to be the case, then any Chinese ADR listed in America will have to delist at some point. And if they do delist from America, where are they going to go, Brian?
So, and this is a bigger problem because this is impacting investors all around the world who have been investing in Chinese stocks, particularly in the past 2 years.
Well, of course, I mean, they see it as a proxy for investing in the Chinese economy. When you invest in a company like Alibaba, Pinduoduo, which operates ride-hailing services in China, JD.com, which sends goods from supermarkets to consumers in China, what you are saying is, if we expect China to grow, then we expect these companies to grow alongside the Chinese economy's growth. But if you cannot invest in these companies because of the Chinese crackdown on tech companies, if you cannot investing them because of the US regulator saying, we want to see these accounts, we want to inspect these accounts, if you can't do that, then of course, there is nowhere for you to go. And if these companies can translate to Hong Kong, say, that would be somewhat possible for people to invest in them. But in the case of Didi, if it doesn't list in Hong Kong and you are an investor in Didi, how are you going to get exposure to, say, the Chinese ride-hailing service? You can't. And so you might as well just sort of take your money off the table now and go, which seems to be what is happening in the case of JD, Pinduoduo, and Alibaba.
Okay, but then, David, let's take I want you to wear your value investor and income investor hat. And if I'm an investor who wants exposure to China, where do I put my money?
Carefully, I think. Choose your stocks very carefully. That's all I can say, because as we know, the Chinese regulators can take aim at just about anything. They weren't really forthcoming in terms of helping out the Chinese developers. People thought, if I invest in a Chinese developer and the economy of China is growing and people are becoming more wealthy and they want to buy properties, then why not go and buy these Chinese developers? Well, you got hammered there, didn't you? And then the tech shares, you got hammered there. Probably the only area where it is still relatively safe would be Chinese banks. And China is definitely not going to allow its banks to fail. But then again, it is really all about transparency. Can you trust the accounts that are coming out? Can you trust what Chinese banks are going to be doing? They will obviously have to keep on looking over their shoulders at the Chinese Communist Party and also the Chinese regulators and continue to keep on asking, can I do this? Can I do that? They don't have the kind of freedom that American banks, even Malaysian banks, Singapore banks have, in terms of how they run their business. They run it according to what the regulators say. So the watchword is tread carefully.
David, as always, thank you very much for coming on the show, and thanks for your insights.
Thank you.
Now, we've been speaking to David Kuo, founder of the Smart Investor out of Singapore, on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Please check out this video and podcast on our website, www.biztech.asia, as well as our various social media platforms. Please like and subscribe to our various platforms. Thank you very much for tuning in.